guys, so it's chapter 4. We're going to do a quick review here in chapter 4. Remember chapter 3, we talked about all the ingredients that go into making the financials happen, right? From revenue, expenses, depreciation, prepaid, unearned revenue, all those things. They all go into it, right? All the ingredients. They go into a trial balance. We make adjustments based on things that happen during the period. We have an adjusted trial balance, and that floods into our balance sheet, our income statement, our statement of cash flows, our statement of stockholders' equity. We can get all that information for those financial reports as we once the trial balance is complete. So, forgive me sometimes, I just speak off the cuff. Whatever's coming in my brain, it's just coming out. So it's fine. So chapter 4. It's basically a lot of the same conversation, except for it's taking things a little bit farther. So, income statement, right? We talked about how that is revenue minus expenses. Well, that is true, except for when you get to chapter 4, you're talking about the multi-step income statement or the single-step income statement. Single-step, revenue minus expenses. Multi-step, now we're talking about sales minus cost of goods sales gives you the gross profit. Okay, so now we're taking it to a different place, a different level. We're adding in a cost of goods sold. What is cost of goods sold? Well, if I own a business that is, I've worked for automotive companies, right? So if you take this automotive experience and you say, okay, I'm selling a widget. All right, what kind of widget am I selling? Well, let me sell my glass of water. Okay, so I'm selling a glass of water. Not the water, but the bottle that's actually making it. Okay. I'm the producer. I'm actually making it. Okay. I'm the wholesaler. I'm making this product. Okay. I'm a manufacturer. So manufacturer is the better word to use there. So in order to make this product, I have to have a straw. I have to have all these little parts, the plastic, the metal, all these things. Okay. These are cost of goods sold. I can't sell this product without these goods in here. Without raw materials, work in process, finished goods. That's all part of the process. So multi-step statement takes it to the next level. It shows what my sales were and then everything that went into the sale up in the top section. And then it has gross profit. And then after that, it talks about the operating expenses. So like selling, administrative expenses, anything to do with developing what you have. Then it goes into other income and expenses, and it goes into taxes. Okay, so it's just a little bit of a different layout. It's the same information, just the layout is different. So don't get confused between single step and multi-step. Same information, different layout. Let me show you what I mean. Okay, so we've been making cookies, and we're in chapter 4, so we're going to finish the cookie making process. What do I mean when I say that it's the same information but a different layout? Well, if I go in and I go to make these cookies, which I'm going to do right now, it's important to have the handy dandy scoop, if you know what I mean. So, I'm going to take my scoop, I'm going to scoop out my cookie dough to put on my thing here. Now that looks like a pretty good cookie, right? So just think of this as revenue minus expenses. This is a single step. But what if I take it and I really want to have like a massive cookie. Wow, that doesn't even want to come off the thing. So if I really wanted to have a massive cookie, maybe I would do things just a little bit different, right? This is just expanding it. It's the same dough, the same ingredients. There's just more of it, more information, more data, more details. It just depends on your company and what you do with your company. So, manufacturers, they would want to break that down. Service industry wouldn't have a cost of goods sold. They're service oriented. They're going to just have a single step revenue minus expenses. Hopefully that clarifies some of that learning for you. I'll be back in just a second to talk about a few other things from chapter 4. Okay guys, I'm back. I just had to try some of the cookie dough. That's usually the case here at the Rhodes house. But I wanted to talk to you a little bit about the balance sheet. I'm on page 188 of your book. If you get a chance, make sure you're reading the chapters. There's a lot of valuable information here. I'm giving you a quick overview and really hoping that maybe it helps break it down just a little bit for you. So the balance sheet. We all know that it's assets equals liabilities plus stockholders' equity, right? Well, let's break the assets down a little bit farther. And that's what it does in chapter 4. There are two types of assets: current assets, long-term assets, okay? Current assets are anything that is going to be turned around within 12 months. That's usually what I say. So cash, accounts receivable, right? Those are current assets. Even if you had a notes receivable, maybe someone owed you money that's not part of the regular accounts receivable, but it's going to turn around within 12 months, I would call that a current asset, okay? So then let's talk about long-term assets: property, plant, equipment. Anything long-term, intangible assets, goodwill. These are all long-term assets. So when you're breaking down your balance sheet, we have a current asset section, we have a long-term asset section. Going forward, chapter 4, we want to make sure that we are putting in our data in the correct place. So cash would be under current, and I usually lead the way with cash at the top. I mean, it is the quickest money that the company has access to is cash. Another one I forgot about, I should have added in there, was current asset would be inventory. So if you have inventory on hand, that's a current asset. Why do we call it a current asset? Because you can turn that around for money fairly quickly within the 12 months. So usually your accounts receivable, this is what customers owe you for either something you sold to them or a service you did for them. Usually you get payment in 30 days. That's the goal, right? Hopefully you're not extending more than 12-month terms. That wouldn't be good. So usually 30 days, even up to 60 days. Automotive industry might even go farther than that. It just depends on your industry. I currently work in the waste industry, and typically it's a 30-day window that it goes with. And like I said, it's industry specific, what's acceptable, what's not acceptable. But it's a quick turnaround, it's a current asset. So long-term assets, like I said, property, plant, equipment. So building, land, equipment, accumulated depreciation. Those are all in that section. And then you go on to long-term, current-term assets. So let's talk, or liabilities, sorry, skipping ahead of myself. So liabilities, current liabilities, what would that be? Accounts payable. Paying your vendors, that's what accounts payable is. You owe your vendors money. I don't know too many vendors that extend terms after 30 days, 60 days. Most of the time it's 15 to 30 days. Then you got to pay your vendors. I just heard the oven. They want our cookies to go in. So I should put them in. See, we're going to have some good looking cookies, I think. But you know what? We're going to find out if they're really good and if all the ingredients are right. In about 7 to 9 minutes. So anyways, current liabilities, accounts payable, maybe a notes payable that you need to turn around before a year is up. Long-term liabilities, maybe you have a bank loan, a mortgage, any of these items that are going to be for the long term, more than 12 months. Most mortgages are not 1 year, right? Most mortgages are 15, 20, 30 years. Even for businesses, 10 years is pretty aggressive. So it just depends on what you have going on. But you have to remember that long term means literally long term. It's past 12 months. It's not current. Okay, so as we go through, and if you look, actually, if you look on page 188, it really does give you some great information here. There's really great chart in here that I think would be good. I discussed everything that was on there, so shouldn't be too bad. Okay, guys, so I'm almost done with chapter 4 review. I'm just waiting for my cookies to be finished. They are almost finished. I'm sure they're going to be fabulous. I tasted the dough, and that's usually a good indication that it's good. So I also did a little bowl for my husband because he loves cookie dough, and he is at work, so this would be a good thing. So I'm looking in chapter 4, and they are going to give us a few ratios to work with in this chapter. For the most part, I do want to say that a lot of the ratios are going to be in the next class in Accounting 1020, but I just want to give you a couple of them here from the book. So liquidity is a big part of financial analysis. Knowing if your company has cash to operate, it's super important. And so they do give us one on page 197, the current ratio, which is current assets divided by current liabilities. This ratio will tell you if you have enough money to pay your current liabilities. So remember, current assets are cash, accounts receivable, inventory. Then you have current liabilities, that's accounts payable, short-term note payable. So these are things that you have to be able to pay rather quickly. So if this ratio, when you do the ratio, if your current assets were $100,000 and your current liabilities were $50,000, then you'd have a 2-to-1 ratio. You have plenty of money to pay your liabilities, and that's a good thing, right? If your current assets were $50,000 and your current liabilities were $50,000, you'd be a 1-to-1 ratio, meaning you have just enough money to cover all of your debt, your liabilities, your short-term debt. And that's still okay. I think 2-to-1 is a better ratio. Personally, just from my own business experience, you don't want to cut it that close, especially with cash. There's always things, got a cookie dough in my hair. There's always things that come up in business. So it's important that we take the time and make sure that we have a good ratio for this, and 2-to-1 is really the preference. At least, 1.5-to-1, where you have a little bit of a buffer. You never know what's going to come up. You never know for sure. So always good to have a little bit of a little extra. So important, if you were to have current assets of $50,000 and current liabilities of $100,000, you're in trouble. You have a 1-to-2 ratio, not good, because now you don't have enough money to pay all your current debts. Now you need to start making decisions. Now, in class, I did notice that one of the students had said that she noticed this right away when I posted the balance sheet on one of the discussion boards, and I thought that was great because that's super important. Having that knowledge that you can look at those numbers and see, wow, their liabilities or current liabilities are more than their current assets. That's not a good thing. They need to make some operational changes ASAP. So that's one of the ratios that is in the book. And so then if you look on page, I'm not going to go through all of them. So look on page 200. This is from the income statement side. Your net income, remember, revenue minus expenses equals net income, okay? So in this, it's return on sales ratio, your net income divided by your net sales, okay? So this is basically telling you what your profit margin is. How much money am I making? So your net income divided by your total sales. Based on sales, how much money did I make? Now, later on in the chapters, we'll be talking about horizontal and vertical analysis, and in Accounting 1020, there'll probably be some of that horizontal vertical analysis. And that ratio, that net income divided by sales, okay, you can that sales number is very important. You could divide every single number divided by sales. So you could say, what was my labor divided by sales? What's that percentage? What does that look like? And then really what you have to do after that is look at the trend. What does it look like for your industry? What does it look like for that type of business that you're in? Because they're all different. So return on sales ratio, net income divided by net sales. So that's something you could do. I challenge you to pull up an income statement. There's a lot of public income statements online. Pull one up and see what you come up with. What do you think about the numbers? What do you think the percentage, the profit should be? Net income divided by sales. So if I have sales of 100,000 and I have profit of 50,000, I'm making 50% off of those sales. That's pretty good. Depends on the industry, right? So different industries have different profits, percentages, different standards, things you want to achieve based on historical trend. So these are things that you could start evaluating online. Really dig into the numbers. Do it for your own household. It doesn't even have to be for a business. You could find out based on your income from your job and then take away your expenses and get your net income afterwards. Okay, so your revenue from your job minus your expenses, get your net income. Find out how much you're really making after all of your expenses. This will really challenge you to look at your own personal expenses and make some changes. Or maybe you're doing great. Maybe you don't want to make any changes. Maybe it'll challenge you to invest more money for future. So things to think about. My cookies are almost done, which means that this online class is almost done. Hang tight. Okay, so this is the last little snippet of this video. And I want to talk a little bit about the statement of cash flows because they do give, on page 201, they are going to give us, oh no, wrong page, sorry. Page 203, they're going to talk about free cash flow. So the greater cash flow you have, the better for business, okay? So free cash flow is cash flow from operation minus capital expenditure. So cash flow from operations, as I discussed earlier, is basically what it takes to operate your business. So paying for expenses, paying for your laborers, paying for subcontractors, paying taxes, whatever that is for your operation of your business, okay, minus your capital expenditures. So capital expenditures, CapEx, if you will, that's buying things like property, plant, and equipment. CapEx, they call it. So capital expenditures. The greater your free cash flow is, the cash flow that you can use for other things, the better it is for your company. The healthier your company will be. And not only that, there's a word that we'll be discussing called solvency. So you want your company to be solvent. When a company is insolvent, they usually go through bankruptcy and a lot of times close the door and never reopen. Sometimes they can reorganize, but the more solvent a company is, the better. So as this chapter is not about all of these ratios. There's just a little bit to learn there to really read about. It's really just to get your brain moving. It's more about the classified balance sheet, right? Remember, current assets, long-term assets, current liabilities, long-term liabilities. Of course, the section on the stockholders' equity. And then it's also regarding the single-step or multi-step income statement. Remember, so revenue minus expenses for single-step, or the multi-step has the cost of goods sold where you're finding out the gross profit, things like that. So, are my cookies done? Well, I think we should go take a look. I think they are. So, as I look here, I see a fabulous chocolate chip cookie. Now, this is the same as in accounting, right? You have ingredients, they all come together by themselves. You wouldn't just eat flour by itself. You wouldn't just eat baking soda by itself. You wouldn't just chug down some vanilla, I hope. But when they're all put together, all these wonderful ingredients, they come up with a really great product that we want to eat, that we want to share, that we want to give to others. The same is for company financial statements, company accounting. When you put all the ingredients together, when it gets all, and when your period is closed, you've finished, you've done all of your adjustments, trial balance adjustments, adjusted trial balance, you can present your income statement, your balance sheet, all these things. You come up with a great thing to show your internal users, your managers, your owners, CEO, CFO, those things, or your external users, the bank, investors, things like that. So when you think about preparing financial statements, it can be overwhelming. It can be difficult. You're not sure where to put everything. Make sure you ask me if you're not sure where it goes. But think about it like this cookie and what it took to get us there. It took us a while, but we got there. We got all the information in. We got all the ingredients in, and now we have this fabulous cookie. That's the same for financial statements. It's very satisfying and gratifying when you actually get all the numbers in to your financials and you actually are presenting good, solid data. So that's it for this week, I guess. Chapter 3, Chapter 4, done. Next week, we'll move on. So let's have a great week. Thanks, guys.